With equity markets consistently putting in new all-time highs over the past few years, it can be easy to ignore the bond market. But when might be a good time to include bonds in your portfolio? And if you decide to include them, which ones are the best for you? If you're new here, I'm Nick, former investment analyst of 9 years, and now I help people with making their money work for them. First, let's have a look at why bonds may have been out of favor compared to equities in the past. These graphs here show the cumulative returns of both the US and the UK over the past 120 years. It shows both the nominal returns and the real returns, which takes into account inflation. And it's these graphs that we're going to focus on the right-hand side. These rates here are the rates that you would have earned above inflation. So as you can see, for equities in the US, it's 6.4% above inflation. In the UK, it's 5.3%. If we compare that to bonds, which is sitting at just 1.7% for the US and 1.4% for the UK. And then short-term treasury bills are even lower, with the US sitting at 0.4% and the UK at 0.9%. So looking at the performance data, it does beg the question of why we may want to have bonds in our portfolio at all, because over that long period of time, it's clear that equities have well outperformed them. But there are three specific scenarios where having bonds in our portfolio could be beneficial. The first is safety and capital preservation. We could be coming up to retirement and we may have grown our portfolio using equities, but now we want to reduce our volatility and make sure we preserve that capital that we've grown. And adding bonds to our portfolio is one way we can do this. The second is equity diversification. Historically, equities and bonds have had an inverse relationship. So while adding them to your portfolio may reduce your returns when equity markets are going up, when there's a correction or a crash, it will reduce your volatility. And the third one is income. And we might have a specific requirement, say we come into retirement and we need a specific amount of return on our investments. By using a fixed income product like bonds, we can be guaranteed we're going to get that rate. It's not going to fluctuate like a dividend would, so we can have more confidence that we can meet any liabilities that we have. Now let's look at the different types of bonds that we may want to invest into. There's many different types out there, but the main ones being government bonds and corporate bonds. Government bonds are usually the lowest risk because you are loaning your money to the government. It's highly unlikely they're going to default on those loans, but you do get a slightly lower yield, especially compared to the corporate bond market, where you can expect a higher yield because you do take on a little bit more risk and therefore you want to be compensated for it. There's also different durations of bonds, and that's measured in their time to maturity. Generally in a normal environment, longer term bonds paying a slightly higher yield than shorter term bonds. If you buy a 30-year bond, that's going to have a lot more duration risk than you buying a 2-year bond. So because of that, you want to be compensated. So generally in a normal environment, the 30-year bond would have a higher yield than a 2-year bond. This is not always the case, and you may have heard of an inverted yield curve, and this is where the longer term bonds actually pay a lower yield than the shorter term bonds. There's many different reasons why this could happen, one of them being central banks increasing interest rates. Rate hikes tend to have the biggest impact on the front end of the yield curve, and you could also see falling long-term rates when the economy slows down. Investors start to look for other places to put the money. Perhaps they don't expect a good return in the stock market, and because yields move inversely to bond prices, those yields will then come down. This is what the UK's yield curve currently looks like, with it generally being flat up until about 5 years, and a more normal yield curve from 5 years going up to 30 years. So as you can see, it may be tempting to want to lock in a rate for 20 or 30 years because you're going to get the highest rates. But in my personal opinion, I do think you take on a lot of risk in doing so, and it's not always worth it. For example, you could lock in a rate of 5.5% over 30 years. But if the yields on longer term bonds increase, then the value of your bond is going to reduce because people are not going to want the bonds that you have because they're going to get a high yield by buying the new bonds. So what that does to the price is reduce the price of your bond. So if you want to sell your investment in any time in that 30 years, the value of that bond could be less than what you paid for it. You can, of course, wait for the bond to mature, but if you're waiting that long, I think you may as well be in equity, because if you've got a time horizon of 30 years, you've got a long enough time horizon to ride out any volatility from the equity markets. So if you are looking to include bonds in your portfolio in order to reduce volatility, then it makes sense to have more shorter term bonds because you're less likely to have that duration risk. So heading over to justetf.com, let's have a look at a few funds that may be worth considering for your portfolio. So let's start by filtering it down. So we can select bonds on the left-hand side here. And for me, I would generally prefer investing in bonds in my home country. So for me, that's going to be the United Kingdom. Generally, you also want it to be your local currency, so you're not worried about any currency risk. You can invest in hedged products, but generally it's just more simple to invest in a bond that is in the same currency that you use. And then for bond type, I'm simply going to select government bond because I want the lowest risk for my portfolio. And I also don't want to take an active view on any specific companies. And then the final filter I'm going to use is fund size of larger than 100 million, just to make sure we're looking at the biggest funds. And then we're down to 13 results. And as you can see, the TER for all of them is very, very cheap. So there's not really much to compare in in terms of price. One thing just to note, especially regarding the duration, when you see a bond, for example, this one's 0 to 5 years, that's good because we know that's generally short duration. When you see one here where it doesn't generally mention a duration, that means it covers all of those durations. We really want to avoid those longer term duration bonds. So for me, the two standouts here are the iShares UK Gilts 0 to 5 years, either the accumulation or the distribution version of the fund, depending on whether you want that income paid out. In terms of yields, you're looking around 4% for these bonds. You could also opt for the Invesco UK Gilt 1 to 5 years, which has a very similar yield. It's just a much smaller fund. But it depends if you have a view of whether you prefer iShares, which is BlackRock, or Invesco. But either of them are going to be absolutely fine for your portfolio. Like many things with investing, it doesn't need to be complicated. You don't need multiple bonds. You don't need multiple bond funds. You simply just need one bond fund that you add to your portfolio. It could be the ones that I've shown you here, or you may have other views. If you're wanting capital preservation because you're coming up to something like retirement, then it makes sense going for accumulation because you're still having the growth. In the bond, you don't necessarily need the income just yet. When you do retire and you may want to have some more income from your investments, then you could switch that to income. But it depends on your circumstances. If you have a really long time horizon, if you're in your 20s and you know you're not going to need the money for 20 or 30 years, then it does make more sense just to stay in the equity markets. You're not as bothered about volatility. You can ride that out and you're going to get the superior returns. Let me know what your view of bonds are. Are you totally going down the equity route and totally ignoring them? Do you think they've come back into the picture now? Yields are a little bit higher than they were a few years ago. Let me know down in the comments below. If you found that useful, guys, thanks for watching and I will catch you in the next one.